more opportunities for us to upsell and cross-sell in an intelligent way driven by AI and machine learning. The third is the breadth of the product that we offer. So, for example, with mobility, with Reserve and low cost, Reserve has been a huge hit for us. And we estimate that 50% of Reserve trips are actually incremental. They wouldn't have happened otherwise. The other 50% are upsell, so to speak. They're more profitable than on-demand trips. Grocery is another example of new products that we are adding on and higher selection, driving higher frequency as well. And then last and certainly not least is the reopening, right? The shift of spend from products to services is benefiting us. So there is a tailwind in terms of people getting out, people shopping more, people going out to dinner more, et cetera. And that is helping our business as well. So it's really membership, platform, new products, and then the macro environment that's helping frequency. And we expect to see that frequency, that 5.4, continue to increase over a period of time. And there's no reason that I see why we shouldn't hit or exceed our all-time highs over a period of time.
Great. Excellent. Thank you both.
You're welcome.
Your next question comes from Ross Sandler with Barclays.
Hey, guys. Just a question about the upfront fare and upfront destination technology that you shipped. So you noted in the letter that you saw about a 4% increase in conversion. So I guess just some context around that. How does this innovation compare to others that you've shipped in the past in terms of like magnitude of overall impact? And as you look forward over the next couple of years, do you see other technology updates that in the future that could be as impactful as what you've done, with upfront? Thanks a lot.
Ross, it's very difficult to predict impact, but I will tell you that the upfront destinations and upfront fares has been one of our largest releases ever. It takes a huge amount of work in the background in terms of training models, testing it out in various markets to make sure that we got it right. And it was the number one requested feature by driver partners. They want to know what the upfront fare is going to be. They want to know what the destination is going to be. It's an important part of the information that drivers process through as to whether or not they want to accept a particular trip or not. And it's just been a home run for us in terms of the number of trips that we're able to drive through the marketplace, so the improved throughput in the marketplace, reduction in cancellations because drivers now know up front whether or not they are going to accept or not. This is a feature that we are now expanding around the world. So we've launched it in the UK now, outside of London. And for example, we see a much higher percentage of fulfillment rates than we did previously. And now we're carefully rolling it out in London, and we will continue to roll it out market by market by market. So it's difficult to predict, what our engineers are going to come up with. We're very, very happy with this feature, but I would never underestimate the power of our engineers at Uber. So hopefully we will have another hit like upfront fares coming up.
Next question.
Your next question comes from the line of Mark Mahaney with Evercore.
Thanks. Two questions, please. You talked about the impact of these newer mobility products. Which of those in particular would you single out as having the most impact? And then just talk about the timing of rolling out upfront fares and destinations globally. Thank you.
Yeah, absolutely. So I think the biggest one for us has been Reserve. If you look overall at the portfolio of new products that we've introduced, those new products accounted for about $6 billion of EBITDA. Gross bookings. I wish it were EBITDA, but gross bookings for the quarter. And it's about 20% of our growth. And that portfolio is growing at about 100% year on year. So it will continue to be a larger and larger portion of our overall bookings. And Reserve is the biggest one. We talked about it being over $2 billion. It is a terrific product, especially as travel opens up. Typically, if you think about traveling to and from the hotel and then coming back, there are about 4 trips that are available to us, and we capture 1 to 1.5 of those trips. So we think there's still a significant runway for us to continue to grow reserve. I am also very, very interested personally in our low-cost product. This is UberX Shared, the opportunity for 2 or 3 passengers to get into the car. It's more efficient for the marketplace. It's better for the environment. Our dream is to have all of our trips shared in an EV. That would be a beautiful thing in terms of congestion and in terms of the environment as well. And then last and certainly not least is hailables, right? There are 2-wheelers, 3-wheelers, but especially taxis. There are over 20 million vehicles that are hailable vehicles in the world. About 4.5 million taxis is a huge base of drivers and vehicles that we think Uber should power, because we are the number one kind of source of on-demand movement in the world. And ultimately, we want to wire up every single vehicle, whether it's a car or a delivery vehicle or a truck or a van or a bus that's available to move people or things all around the world, and taxis and hailables are a big part of it.
Next question, please.
Your next question comes from the line of Justin Post with Bank of America.
Great. Thanks for taking my question. Maybe one for Dara, one for Nelson. On the outlook for 24, I think there's been some headwinds from FX and some other things. Any updates on that, and maybe some of the puts and takes as you think about that you gave last year? And then, Nelson, a couple of the cost issues maybe in the quarter, the New York minimum driver fee changes and insurance costs. Maybe you could cover those and how you're thinking about the potential impact in 23. Thanks.
Well, I'll try to answer both of them. So in terms of the FX, so we do give you constant currency numbers. The FX has gotten better right now. We don't necessarily put that into our 24 as we're thinking about 24. We laid out guidelines last year, as you recall. We think we've over-delivered against, particularly on the bottom line, the incremental margins and the profitability. Our focus is to make sure we continue that path. And again, we are focused on trying to deliver a GAAP operating profit at some point this year. And again, we think that we will continue to do well versus the targets we laid out. In terms of some of the costs, those are things that we just have to continue to mitigate. Specifically on New York, a lot of it just has to do with transparency. A lot of it just has to do with making sure that the rule set is correct. The new 6%, again, it will get absorbed into the marketplace. And then your question on insurance, I would tell you, is the one line item, because we've scrubbed our whole company on every single line item. And that's the one line item that we frankly haven't made progress on in terms of reducing the cost per trip. A lot of it is just built on what's going on more broadly in the insurance industry as the market continues to be a hard market. A lot of it has to do with the fact that I think even the insurance companies are having the challenges now to do the actuarial work, because to repair a car is much different, right? The rear view mirror that was $70 is now $700 with all the electronics. And so we frankly, and obviously our earners are part of that ecosystem. We're as you know, we take our charges in the quarter when they come. We've done a good job managing through that. But again, I think insurance will continue to be the one item that we haven't been able to optimize. And Dara spends a lot of time working with me and our team on how we go do that. But if you think about every other line of our P&L, we've actually done a pretty good job in terms of driving efficiencies out, and we'll continue to focus in on that.
I realized that I neglected to answer Mark's second question in terms of the rollout of upfront fares and destinations. This is a very complex product that we're rolling out, and we have to make sure that our models are properly trained. So we are in the middle of our rollout in the UK, and we'll continue to roll it out across major markets where appropriate. I would expect that upfront fare and destination will be rolled out in all of our markets globally by the end of the year in markets in which we can roll it out. Depending on regulatory issues, et cetera, we may not be able to roll it out in various countries, but I would expect a full rollout by the end of this year in markets where it's appropriate.
Thanks. Next question, please.
Your next question comes from the line of Doug Anmuth with JP Morgan.
Thanks for taking the questions. I just wanted to circle back on the delivery margins. Can you just help us, Nelson, perhaps split out some of the improvement across network efficiencies, advertising, and marketing incentive optimization? Thanks.
No. Look at it. We're focused on delivering the incremental margins that we laid out. We certainly have delivered way above what we've been talking about long term. But we expect to continue to try to deliver against the 7% total company. And we're going to continue to look for efficiencies across. And so what I try to do there is let you know that some of them were very deliberate actions that we took in terms of making sure that we are running and the marketplaces are running more efficiently regarding incentives. Some of it is just tech that we deployed, and we deployed the tech in the first half of last year, and we really saw those benefits on the cost per trip. And then again, we've talked about some new business things. And so ads is the easiest example where we've seen that continue to grow. So the ads business, we continue to expect to continue to grow and accelerate the growth. And so we'll see the benefits in the margins. I think we'll continue to run an efficient marketplace. And so, yeah, I think you should expect that we'll continue to drive margins in those businesses. But remember, we also spend time trying to invest back in. So we've invested and we've talked about it. There's some growth markets like in Japan that we've invested in. And again, we now are number one in Japan from a category position perspective. So we try to manage, we're going to balance, both the growth as well as the margin and the profitability. And I don't want to be too prescriptive in terms of exactly what we're doing.
And I think just on ads, for folks out there, we passed 500 million in annual run rate, and that's based on increasing the number of active advertisers that we have by 80% on a year-on-year basis. But if you look at the merchant penetration, the percentage of merchants on our delivery side who are advertising, only 25% of our merchants are active in the auctions that we have going on. So we think there's substantial upside to our advertising business. We committed to $1 billion in revenue by 2024, and we are progressing very, very well against that target. So you should expect to see more upside, both, by the way, in our delivery business, but also in our mobility business. We've seen some really encouraging signal as it relates to journey ads on mobility, which you see on the app. Click-through rates over 3%, CPMs of $45, which is pretty amazing. And then a new class of ads that we're actually pretty excited about are car tops and tablets, where the goal of those advertising is really to put more dollars in drivers' pockets. We'll run the advertising networks, we'll sell the products, etc. But the goal of those products essentially is to get drivers greater earnings on a monthly basis, which then will translate into more drivers on the platform and a more dependable Uber for everyone. And that works out for the marketplace, and it works out for us as well.
Thank you both.
You bet. Next question.
Your next question comes from the line of Deepak Mathivanan with Wolfe Research.
Great. Thanks for taking the questions. So first, on the weekly active user penetration, it seems like in some markets like UK are already above kind of the pre-COVID levels, but it's still below in large markets like US. Is there any broad reason for this lag on the user side, and how should we kind of think about this in 2023? And then for Nelson, as we go into the kind of annual comp cycle, I hate to be the guy that asked the SBC question, but how should we think about the target compensation levels in 2023? Any high-level color you can share on your thoughts there would be helpful.
Yeah, I'll start on the user trends, and then Nelson can talk SBC. The reason for the U.S. trailing is really the West Coast. So if you look at the U.S., it's really a tale of two coasts. If you look at a Miami or a New York or an Atlanta or getting off the coast in Austin, Houston, etc. Most of the U.S. Is at pre-COVID levels. Canada, for example, our neighbors in the north are above 2019 levels as well. But it really is the San Francisco's, Seattle's, Portland's, Los Angeles's of our country on the West Coast that are trailing and are off the pace that we see pretty much everywhere else in the world. So I wouldn't generalize the U.S. Kind of non-West Coast looks great. The West Coast is recovering, and we talked about in January we are having, on a daily basis in mobility in the U.S. trips approach pre-COVID levels as well. So all the trends are moving in the right direction, but the West Coast is definitely leaving the U.S. behind the recoveries on a global basis.
So regarding stock-based comp, so we are looking at all parts of our cost structure, including employee compensation. We recognize, and there is a fair amount of noise, particularly on the West Coast, regarding stock-based compensation. What I would say is that we expect our employment levels to be our headcount to be relatively stable this year. We will continue to focus on performance management across all of our businesses, and so you saw that we took some action in our freight business in January, and that was specific to the freight in the marketplace, and there'll be some other pockets of that that will happen during the course of the year. I think you won't see any demonstrable change in stock-based comp, but because it takes a long time for that to build out. But we are certainly going to manage our headcount very judiciously. And then the only thing I would add is that because we are trying to start focusing in on GAAP operating profit, it obviously is part of the calculation. And so we recognize that as well. And so as you think about the progress we've made on EBITDA, on free cash flow, and now with our focus there, you can envision the amount of focus that line will have as we move forward.
That's very helpful. Thank you both.
Your next question comes from the line of Lloyd Walmsley with UBS.
Thanks, too, if I can. First, just on Uber One, you talked about a strong pickup in spend and clearly like a nice LTV that covers CAC pretty quickly. But once you're through that kind of startup cost, what do contributions look like for Uber One members versus like a non-member? And how much of a trade-off is the margin for the profit dollars in that plan? And then secondly, do you think that driver supply is benefiting at all yet from slower economic growth? And to the extent we're seeing some of that or eventually see that, how do you think about pricing and take rate on the mobility side if you get better and better supply? Thanks.
Yeah, look, Lloyd, I don't want to get into too much of the particulars of Uber One because, as you can imagine, a bunch of information, the data there is proprietary. But if we get an Uber One member who sticks around for a year, that Uber One member generally will be unprofitable. It's really in the second year where that Uber One member will be profitable, and that's just a trade-off between frequency, average order value, and margin. And we're actively making that trade-off and driving Uber One penetration. Another side benefit of Uber One is that our merchant base, an increasing percentage of our merchant base in a delivery business, is willing to pay to have, let's say, advantage exposure to the most valuable members that we have as it relates to the Uber audience. And as you can imagine, the Uber audience is a high demo audience that moves, that spends on services, that gets out of the house. And it's a very, very attractive demographic, both for our merchants and for advertisers as well. In terms of driver supply levels are very, very healthy, right? Drivers are up 35% on a year-on-year basis. New driver count is up 34% on a year-on-year basis. And we have heard from our drivers that inflation is a factor that they consider. About 70% of them that are coming onto the platform are coming on to make more money so that they can afford to live in what has been an inflationary world. So we certainly think that the economic environment could be a tailwind there. And in markets where we have seen economies get weak, in the past, and Mexico's been through some recessions. Brazil has been through some recessions. We definitely see weaker economic environments helping out in terms of our driver supply. That is a tailwind in terms of trip volumes. It's difficult to tell if that's what we're seeing. You'll remember that, for 24 months now, we have been very, very focused on improving Uber as a platform for our earners. Come on in quickly, make a lot of money delivering quickly. Then once we have, then we'll upsell you to driving. Driver earnings are $35 per utilized hour, so they're at very, very high levels. Driver earnings increased by 37% on a year-on-year basis in terms of constant currency. So I think just the earnings levels and the service that we are providing our drivers is a tailwind in addition to the economic environment out there. And when you put it all together, it results in a service where surge levels are coming down. So surge levels in January, for example, in the U.S. are under 20%. ETAs are coming down. ETAs in the U.S. are about 4.5 minutes in January as well. So the marketplace itself is getting a lot more healthy, and drivers are earning well at the same time, which is exactly what we want.
Okay, thank you.
You're welcome. Next question.
Next question comes from the line of Ron Josey with Citi.
Great, thanks for taking the question. Dara, on delivery, we're constantly talking about or getting questions on the demand side here, just given macro challenges. And, from what we're hearing on growth in January for delivery and accelerating expected growth, I guess, in February and March, you mentioned habitual in the letter. How much do you think of this growth here in delivery is category adoption, better convenience, et cetera, or Uber specific, as you mentioned, maybe competition isn't as great and things along those lines? Thank you.
Well, I think that overall in the category, the delivery category has been pretty resilient post-pandemic, certainly more so than a lot of other categories that benefited from the pandemic. That said, we are growing faster than the category generally if you look at us globally. Certainly in Europe, we are seeing many of our competitors pull back significantly from what were unhealthy spend levels in the past that didn't make any sense. They made sense in terms of top line, but they certainly didn't make sense in terms of bottom line. And for us in delivery, we're benefiting from the power of the platform, very cheap audience from our rides business. Remember, we get more new eaters from our rides app than we do from Google and Facebook and Instagram combined at about a quarter of a cost. So that is a very significant structural advantage that is assisting our delivery business. You've got our membership business that, again, is adding higher frequency, higher spend, more retention as well. We're the only player out there that has membership both on mobility with mobility and delivery benefits as well. And then you've seen our tech, which is optimization around cost per transaction, and then an ad business that we're building that is starting to scale. So the combination of all of those four factors, I think, is allowing us to outgrow the category, which generally has been more resilient than other categories as well. And I wouldn't expect anything to change going forward. We do think that we should continue to outgrow the category in delivery going forward based on the environment that we're seeing.
Thank you, Dara.
Next question. You're welcome. Next question.
Next question comes from the line of John Colantuoni with Jefferies.
Hi, thanks for taking my questions. So mobility continues to deliver impressive bookings growth. Maybe you could just help give us a sense for how share gains are playing into that versus broader recovery and category usage as we move further past the pandemic. And assuming you are seeing some share shifts, are you starting to see evidence that the investments you've made in driver supply technology and Uber One are allowing you to leverage your network effect in driving sort of a permanent competitive advantage that could drive ongoing share shifts in certain markets? And then second question about freight. Bookings and EBITDA for freight were a bit behind our expectations. Maybe you could just discuss how it compared to your own expectations in the fourth quarter and some puts and takes of what drove could have driven that delta relative to your own expectations? Thanks.
Yeah, the first thing I'd say, John, is that I've never seen a permanent competitive advantage in my life, and we don't expect to, right? So the advantages that we have in terms of our business and in mobility, we are gaining category position, and we're gaining category position certainly in the U.S. We are in Europe and in the UK and Australia, et cetera. We're seeing one of our competitors in France, spend a ton of money, which doesn't seem to make any sense whatsoever, but they've done it before and we pushed them back. We don't consider spending more money a strategy, right? It's just like maybe that's a strategy when the only thing that counted was how much money you could raise. And while we see some of our competitors kind of trapped in the spend more money strategy, if you want to call it, we are driving, we're using efficiency, we're using technology like upfront fares and destinations, and we're using the power of our platform with membership to win category position the right way. And the right way for us is grow strong top line faster than the category and leverage a bottom line so that you're profitable and you continue to increase profit margins as well. So right now we are seeing kind of the positive feedback loop of more driver supply leading to more demand, leading to more data so that we can target the demand, so that we can match the right driver to the right rider, whether it's reserve or on demand. That feedback loop is happening, but we are going to have to stay on our toes to continue to gain category position while improving margins, and we don't take a minute of that for granted. We'll continue to do our best. The results in the last year and a half have been really, really good, and the trends that we're seeing for now are really good. But the minute we take our foot off the gas, is the first minute that a competitor starts to get an advantage over us. So we don't take any of it for granted. Nelson, you want to go?
Sure. Regarding Uber Freight, so yes, we're watching the same trends you are. Yes, we wish the freight numbers were better in the fourth quarter. But as you know, there's a little bit of a cyclical nature to what's going on more broadly in the industry. The business continues to do well. And so, as you know, we bought the Transplace business in December of 2021. We spent a fair amount of last year integrating the business in. Transplace 4PL business continues to be resilient with everything going on. And what we've seen is our Uber Freight, the historical Uber Freight business, has done a very good job using the brand and our tech, our shared tech, to really drive out and build out its presence, particularly with what I call national brands. Where we need to spend some more time is really focused on the small and mid-sized shippers, and so we're doing that right now, and we've made some organizational tweaks. We do expect that you'll see us getting some traction there, but the overwhelming cycle that's going on right now more broadly on the freight industry is going to continue to impact our business, and so that business will continue to lag likely versus where we would have hoped, and certainly versus a year ago where there's a much different dynamic more broadly in freight in this country.
Operator, we'll take our last question now. Thank you.
Your last question comes from the line of Nikhil Devnani with Bernstein.
Hi, thanks for taking my questions. Just a couple, please. Looks like the leverage on promotional spending has been quite good. I think it's the third quarter in a row of sales and marketing dollars stepping down. How much more efficient can that line get? And as a follow-on to that, when you think about your ambitions on gross bookings growth, do you expect to ramp promotional spending down the road, or do you feel comfortable about growing the business while continuing to get leverage against that item? Thank you.
So I'll start on the first one, and Dara can handle the second half of it. So again, we're focused on really delivering and balancing our growth and our efficiency. So that's been our path. And I talked about when we took our big call to action in 2020. So as a company, we were focused on growth and efficiency. We recognize that we put out targets last year, and our goal is to make sure we achieve or overachieve against them, which I believe we have, if you think about the last 6 quarters. And so there are times when we might take some incremental dollars and spend back in a specific marketplace, and there would be strategic reasons why we would do it. There might be some situations where we pull back. And so we have a capital allocation framework that we've had now for the past few years, and it's working well, is what I would say. And so I don't want to say, could we actually get very super efficient in the quarter? Maybe. Would we? Likely not. We still think there's a lot of growth, and so our goal is to really think about, as Dara said, kind of where the puck's going, and making sure that we are investing behind those growth levers so we can deliver the kind of top line growth we're doing, and over delivering against the bottom line, which we have been doing.
And if you know, in terms of ramping S&M to drive top line, the way I describe our activities is it's exactly like Nelson said. Generally, we want to leverage all of our cost lines, the cost of sales, marketing costs. Certainly, we want to leverage our operating costs and make sure that we stay lean as a company. It's just much more fun to win as a small team versus big teams, and that allows us then to lean into different segments of the business that we want to specifically grow, whether that's a specific geo or that's a specific product. You see us with our Super Bowl ad with Uber One. That's an expensive ad that is leaning into Uber One to drive growth in a very, very strategic product of ours. So strategically overall, our efficiency or drive to efficiency across the business then allows us to strategically invest in various geos or various areas. And yes, that will include investments in marketing. It'll include investments in tech as well, so that we can strategically grow where we can build an advantage over our competitors. And as long as we keep kind of driving this efficiency every single day, every single week, every single month, every single year, that opens up avenues for us to invest and deliver the bottom line that investors are looking for over the long term. All right.
I appreciate the color.
I think that's it. Yeah, you bet. Thank you everyone for joining us. Huge thank you for the Uber team delivering another great quarter, and big thank you to our earners who, without whom none of this would be possible. 2022 was a really, really good year for the company, and we're looking for 2023 to be an even better year. Thank you, everyone.
Ladies and gentlemen, this concludes today's conference call. You may now disconnect.